Hello there. I hope that you are doing well. Welcome to the sixth lecture of the Day Trading Model Series. During this lecture, we're going to talk about environment selection. Environment selection is by far one of the most important things to understand and to master, because having an understanding of the model, of what it looks like, the rules, all of that is simply the foundation. It's basically the thing that you apply when the right environment is present. So before you can even look to apply the rules that have been provided to you thus far, you must first know and learn when those rules can be applied and when they cannot be applied, because that's even more important. So this lecture will be by far one of the most significant lectures thus far, because this lecture will teach you when to look out for something and when not to look out for something. And that is something that 99.9% of all the traders out there don't know. They just show up every single day and they see a pattern and they trade it. And they wonder why their win rate, why their precision is off. It's because they don't understand when and why and where the pattern should work. That's it. So that's what we're going to discuss during today's lecture. Before we begin, I must first give you an obligated risk disclaimer, of course. I am not a financial advisor, nor is TOTK the one said no. You have signed up to the mentorship platform, and whilst doing so, you have agreed upon our terms of services, which state that you accept that everything that gets shared is meant for educational and or entertainment purposes only, meaning that none of the information that I will share during this lecture can be used for financial investments by yourself. And we are not responsible in any way or shape. If you want to read the full risk disclaimer, you can do so by going to theonesetno.com. So let us first take a look at the table of contents for this lecture. We're first going to take a look at the economic calendar. That means that we're going to take a look at how we can use the economic calendar to determine what days and sessions are high or low probability sessions. Next to that, we're going to take a look at the session profile, meaning what is the current session likely to look like? How is it likely to deliver? Next to that, we're going to take a look at intermarket relationship. And finally, we're going to take a look at macros and price delivery. This is going to be a lecture in which you will have to take either a lot of screenshots or notes, because these rules will be very insightful down the line. Because when you start studying historical market data and you start studying when the model does not work and when it does work, you will figure out very quickly that the rules that will be presented today are of great influence to determining when the environment is high probability and when it isn't. High probability being the following: a high probability environment is an environment in which the odds are in our favor, meaning that there is a high chance of our thesis, of our draws of liquidity, being right, being correct. Let us first take a look at some general rules for the economic calendar. First of all, a no news Monday gets avoided at all costs, unless it's NFP week, meaning that if there is no news on Monday, we avoid this. The reason why we want to avoid a no news Monday is because no news Monday is usually very choppy when it comes to how the markets deliver. This is something that I've experienced in the past tremendously, when first of all going through old market data, historical market data, but also whilst trading or trying to trade it live. The delivery is not clean most of the times compared to the other days. And it has to do with the weekly accumulation that takes place on Monday, meaning that the whole weekly delivery is basically being set up on Monday or at the beginning of the week, I must say. And therefore, we want to avoid a no news Mondays. Significant high impact news during a session can result in chop the session prior, Meaning that if we, for example, have high impact news during the morning session, during the New York morning session, that is significant, we can anticipate the London session, which is the session prior, to be choppy. Note that this is only the case when there is a significant high impact news driver. During this lecture, we will discuss what news is significant and what news is still important but not as significant as some other news events. The reason why the session prior is likely to be choppy is due to the fact that liquidity usually gets engineered that they will be able to utilize with the release of the news event for manipulation purposes. Unless a market maker model is confirmed, meaning that the low risk phase has provided one-sided order flow, the low risk phase being either the low risk sell or the low risk buy, we do not try and predict what the high impact news will be utilized for. And the reason why I'm saying this is because let's say that you think a smart money reversal is in and news comes out in a few more minutes. Let's say that you believe to have seen displacement at the CB form. You try to short inside that CB. And now the news comes. And it immediately runs higher, it takes you out. What did you do wrong? You did not wait for significant signs of the market maker sell model being confirmed. And that's what we often see. When the market maker model is not confirmed yet, meaning that the low risk phase is not confirmed so far, the news can be utilized for another run higher for manipulation purposes, and then begin to show signs of a reversal occurring. When the market maker model is already near completion, meaning that we've already seen the market trade away after forming, for example, the low risk sell within a sell model, and the first distribution stage taking place, and now we're at the second stage of distribution, then news is likely to be utilized for the heavy repricing lower towards our target. And the reason why this is important is because by knowing this and by studying this, you will see at what times people that trade in front of news get it wrong and get it right. Let us now take a look at the economic calendar for an NFP week. For an NFP week, the focus is on the beginning stage of the week, meaning Monday till Wednesday's AM session. The reason why we want to focus on these days is because, first of all, it's the first week of the month. So that means that the first week of the month is crucial for determining how the remainder of the month will likely deliver. That's also why NFP takes place at the beginning of each month, because they utilize it to basically reprice it aggressively to, for example, basically confirm what the delivery for the remainder of the month is likely to be. That's why NFP is a crucial reference point, and that's why oftentimes you see NFP just be one very heavy repricing, one-sided, and that is crucial for the monthly delivery. And because this is the case with NFP, we do not want to basically trade the day prior to NFP, meaning the Thursday, because the Thursday is going to be very messy. It's usually very choppy. And same for, of course, the London session on NFP days. The only reason why we want to look to trade on Friday is after NFP's release and after we have seen clean delivery, but we will touch on that soon. The reason why we want to focus on the beginning stage of the week is because the beginning stage of the week is likely to be utilized for the nice clean order flow instead of the final part of the week. Because there are still orders that have to be fulfilled every single week. So when do they do that? Do you think that big institutions would wait for basically Thursday or Friday to fulfill their orders? To make the transactions required? Of course not. Why not? Because the risk is too high. So they do it early on in the week. And that's why you see the cleanest delivery during NFP weeks early on in the week. So here you can see the rule: avoid Thursday at all costs. It's not worth even looking at Thursday during NFP week because the delivery is going to be very choppy. Usually avoid Friday's AM session as well, because when NFP reprices aggressively one-sided, the delivery afterwards is usually not pretty neither. It's usually very slow delivery, and if it begins to deliver, it will be quick. However, the amount of PD arrays that form during that period are usually not a lot. So therefore, if you want to still trade after NFP, the focus should be on the PM session. So the focus is then on Friday PM. We're now going to take a look at the economic calendar for an FOMC week. FOMC is always on either Tuesday or Wednesday. So that means that if FOMC is always on Tuesday or Wednesday, we can already know that the day prior to FOMC, we want to be very nimble when it comes to taking risks. And the reason why we want to be nimble is because FOMC is next to NFP and next to CPI, that we will discuss soon, one of the most important economic news drivers that takes place, that is fixed. Of course, there are also random, so to say, events that take place that have a huge impact on the markets when it comes to volatility injections. But these are the volatility injections that we are aware of, that we can see coming because they're already scheduled for the whole year, basically. But because we know that FOMC is always on either a Tuesday or Wednesday, we want to avoid the day prior. Meaning that if FOMC is on Tuesday, we want to avoid Monday. If it's on Wednesday, we want to avoid Tuesday. And the reason why we want to do so is because for FOMC, again, a lot of liquidity has to be engineered that they can attack during that news event. Whenever there is FOMC in the afternoon, avoid AM at all costs. Meaning that if FOMC is, for example, during Tuesday's PM session, we will avoid the AM session at all costs. And the reason why we want to do this is because the AM session is likely to deliver in a very tight range. If FOMC is during Wednesday's PM session, we will, of course, look to avoid the Wednesday AM session for the same reason. Now, it's very important to note that FOMC is something different than FOMC minutes. They are two different events, meaning that the FOMC that we're discussing now, that we are being very cautious about, is the following. It's a two-stage delivery event, which means that the first manipulation run occurs at 2 p.m. and then the second manipulation at 2:30 p.m. We look to engage post 2:30 p.m. There's another FOMC event which is called FOMC minutes. This event is basically a 1 moment volatility injection, just like any other regular high impact news driver visible on Forex Factory. So if we know the difference between FOMC and FOMC minutes, we can say that FOMC is basically the news driver that we're discussing these rules for. And for FOMC minutes, the same general rules apply as discussed prior. So let's take a look at the economic calendar for CPI. CPI is always on either Tuesday, Wednesday, or Thursday, or it's basically during the middle of the week, between Monday to Friday. Don't trade the day before CPI. The reason why we don't want to trade the day before CPI is because, again, the day prior to a significant high impact news driver is likely to be choppy, meaning that liquidity gets engineered, meaning that time distortion is likely to take place, meaning that the marks are likely to be held in a tight range, consolidate, and then that consolidation will be utilized for the repricing during CPI. A general rule of thumb when it comes to CPI and NFP and FOMC is that you never want to stand in front of them, meaning you will not try and gamble on the outcome of these events, because these events have an increased likelihood of being used for manual intervention, meaning that if someone or an entity literally goes into the markets and says, we need to reprice it to this price right now. And that's when you see like a one-sided up close or down close candle of a lot of points or handles or pips. If CPI is on Tuesday, we skip the Monday. If there's CPI on Wednesday, we skip the Tuesday. If there's CPI on Thursday, we skip the Wednesday. We're now going to take a look at something more advanced because the rules for the economic calendar are pretty straightforward when you understand them. And one thing before we dive into the session profile is that for the economic calendar, it is crucial that you really spend time investigating whether or not what I just outlined to you has an increased chance of you staying outside of low probability days and taking unrequired risks. Because if we know that a session is low probability, why would we even decide to look at it? How to detect if the session is likely to chop around? First of all, we will take a look at the economic calendar. For example, the day prior to significant high impact news is likely to be filled with choppy sessions to engineer liquidity as explained prior. If we know that this is the case, if we know that there's a significant high impact news driver tomorrow, what can we anticipate for today? We can anticipate today to be a mess, and therefore the best thing to do is to walk away. Secondly, a choppy session usually takes place when there's no clear higher time frame draw on liquidity, meaning that it's not clear on the higher time frames what the move from point A to point B is. Therefore, we need to wait for more market data to become available to signal to us this is the next likely move. Thirdly, we will take a look at intermarket relationship not supporting one-sided order flow. Meaning that intermarket relationship is not showing signs of, for example, the dollar distributing lower whilst the index futures are going higher, or for example, the index futures themselves not being in sync with one another. When one of those two scenarios occur, we can anticipate either a very choppy consolidation range or a high resistance liquidity run. Neither of those scenarios are preferred because our job is to determine low resistance liquidity runs, the runs in which you enter and it immediately begins to expand. And finally, the macros not supporting one-sided institutional order flow, meaning that the macros that we are focused on not showing signs of the market wanting to reverse or expand, therefore not move in a one-sided direction. Because if that would be clear, if that would be obvious, then of course we can say, well, the only reason why the macros would begin to expand is because there is a clear higher time frame draw on liquidity and because the market is predetermined to expand during that session. But if that is not the case, if those macros are not supporting that one-sided institutional order flow, then it's a very big warning sign that we either completely walk away, decrease risk significantly, or cut our positions quickly, rapidly, trail our stops aggressively. We're now going to take a look at a chart example where we can see the macros not delivering one-sided institutional order flow. This was the PM session prior to NFP, so this is exactly the delivery that could have been anticipated. What we can see is that even though during the 11:45 to 12:15 time window, the market trades higher, we see that it's very messy. We see that there's a lot of back and forth going up, sideways, up, sideways, up, sideways, up, sideways. And then it retraces, 12:45 to 1:15 comes along, consolidation, very slow repricing higher, repricing higher, 1:45 to 2:15, market turns around very slowly and it goes sideways, it consolidates, and then between 2:45 to 3:15, a few minutes of distribution occur, market reprices lower aggressively. Are you noticing how there aren't any real expansion legs during this whole delivery, during this whole PM session? Meaning that there is a lot of back and forth going in which the order flow itself is not pretty and it's not nice delivery at all, especially this reversal right here. And when you see that this is the way that the market is delivering, where the candles themselves are rather small, meaning that the volatility that is present is not that high, is a sign that, okay, this session is likely to chop around a lot, and this means that you either walk away right away, or you say, okay, I'm going to decrease the risk because the likelihood of the market not expanding is very high whenever it's the day prior to, for example, NFP. And this is a perfect example of what a PM session prior to NFP looks like. Meaning that the delivery is choppy, the delivery is slow, the delivery is not aggressive. Even though there might be imbalances that you can trade off, it's not worth risking anything in my honest opinion. Please don't fall for the following trap. This is a trap that many people fall into when they begin to learn about rules for environment selection, and it's the following trap. Please be mindful of this. Here we can see the Monday prior to CPI. So CPI was on Tuesday. What do we know? Whenever there's CPI on Tuesday, we want to avoid No News Monday, because No News Monday is likely to chop around. What we can see is that during the AM session, the market repriced higher. Then during the PM session, the first 90-minute PM cycle, the market forms a high and it begins to reverse or show signs of reversing above the AM high, above the morning high. Now I'm going to ask you whether or not the delivery above the AM high right here, showcased by this gray box, is clean. Is this a clean market maker sell model to you? Is this whole leg, which could be the low risk sell followed by the distribution, followed by again distribution, clean? The answer is of course no. Why not? Because it's the day prior to CPI, meaning that there is a lot of back and forth going until the market is finally allowed to expand lower aggressively. And this is exactly why the majority of people fail themselves, because they don't understand that these type of days in which there's this nice low resistance liquidity run lower are not representative for all the Mondays prior to CPI. And therefore, when someone sees this that is completely new to the markets, they immediately feel like, whoa, damn, I could have participated in this whole move lower. I could have shorted it above the AM high. That's what a point of interest is for the PM session. You know, that's the mindset that a complete newbie has. They are driven by emotions. They are driven by, for example, fear of missing out. So they want to be in every single move. And I'm telling you right here, you will never capture every single move. And neither should you even want to. Because why would you want to create so much mental baggage for yourself that you engage in low probability environments? And even though an environment like this might deliver one day, the next time it will likely not. And the next time after that, again not. And you just engage in 2 low probability days because on the first low probability day, the market delivered. And you thought, okay, this is representative for all those days now going into the future. Absolutely no. And that's exactly the reason why sometimes these type of days get utilized for still clean delivery, to trap people into believing that every single low probability day like this within such an environment is going to deliver this way. And I'm telling you, it is not. And if you spend enough time in the charts, you will figure out that that is the case. And therefore, you need to give yourself permission to say, I am going to determine the environment, and based on the environment selection that I subscribe to, I choose whether or not I would even look to engage within a session. That is how you decrease the frequency of trades, that is how you decrease the amount of risk that gets taken, and that is how you gain a edge in due time. Because you will be able to refer back to all the times that you engage in environments that were not preferred, and you will be able to learn from that. So this was a very important chart for me to share, in my opinion, because I feel like this is something that could potentially harm someone that's completely new. They might listen to the rules that I'm providing here within this lecture, and they might look at the chart still one day on one of those days that I told you to avoid, and they see the clean delivery, or they see a low resistance liquidity run, and then they think that that is representative for all of those days. and then you think I'm wrong, and you think that the rules, the logic that I'm using doesn't work, etc. Well, I'm telling you, this logic is what keeps you out of the mess in the long run. And one day of okay delivery doesn't mean that you can then expect that same delivery to occur on every single day that has the same environment. So when you determine a session to be low probability, why are you even looking at the charts to trade with your capital? Why would you even do that? When I ask you the question, doesn't it make sense to just run away, to do something else besides trading, to do something fun, to spend quality time with your loved ones, maybe to just relax, to recharge for high probability days? Of course, of course that makes sense to do that. But the reason why you're still looking to trade is because you're addicted to doing something. And that is something that we will discuss during the psychological lectures that you will have to get under control. Because that's right there is a sign of a potential gambling addiction in which you want to do something. You want to just feel the urge. You just want to take the risk. You just want to push it. And that is wrong, my friend. You need to control yourself, and that you do that by simply saying, I will only submit to look at high probability environments, high probability days. And that means that you can immediately decrease the amount of days that you will be even looking at the charts significantly. And that time you can utilize for other things. And isn't that the goal of trading? To not be addicted to the charts all day? Of course it is. Of course, that is the goal. To be able to determine this day is high probability, that day is not. So therefore, I should avoid the low probability day. If you still decide to look at the charts on a day that you have determined to be low probability, decrease the risk significantly. Meaning that if you take a loss, that loss will not make you worry about it. That loss will not make you upset. That loss will basically be counted by saying, you know what? I was in a low probability environment. I took a minor loss. That's it. If you over leveraged on a low probability day, the mental baggage that will carry along with it will not be worth even taking the risk in the first place. And you will have to experience that a few times before you understand it. And when you understand it and when you experience it, you will come back to this lecture, maybe in a month, maybe in a few months, maybe in a few years, and you will think back to me saying this, and you think, damn, he was right. Imagine what it would feel like if you would take an unrequired loss with a large amount of risk in a session that you already recognize to be low probability. Just imagine what it would feel like. Just close your eyes for a second and imagine yourself going through that. Imagine how you would respond. Imagine how you would feel. Imagine maybe the amount of sweat that you would create or the pressure that you would feel. Would that be worth the risk? Would it be worth it to risk something in such an environment? You already know the answer to that question. It's just that the impulsive person inside of you is still trying to make you trade days that are not high probable. And that is where the analyst has to be in control no matter what. Because environment selection is a result of determining, okay, when is the market likely to deliver in the sense, in a way that I want it to deliver. And the only person that can determine that is the analyst inside of you. There are three main drivers inside of each one of us. We first of all have the gambler, we have the trader, and we have the analyst. The reason why the gambler is in the first place is because this is our human nature. This is how our brains have been created. We are impulsive, we are emotional, we are basically flawed in that sense, meaning that we can do things based on emotions. This is how the markets take money from everyone. The trader is in the middle because this person is the person that executes, the person that puts in the positions, manages the risk, and executes it. And the third person that could be in control is the analyst. and the analyst is the one that listens to sound logic, that listens to his protocol, and is able to do things based on that. You need to always have the analyst be in the control of your own actions. Or as ICT always used to say it, make the analyst be in the driver's seat. Always. Because if that gambler of you is gonna sit behind the steering wheel, things will go wrong. And to avoid the gambler being allowed to sit in front of the driver's seat, in front of the steering wheel, I must say, the one thing you can do is simply basically making sure that the analyst makes a good preparation. This is the day I'm looking for to trade. This is the day I'm interested in, and then showing up to that day and not showing up to the day that you're not interested in. Because by showing up to a day that you're not interested in, you're already giving the gambler an edge, because the gambler is already like, oh, today the trader is not completely listening to the analyst. Maybe I can slip in. And that right there is the devil, my friend. And I'm sorry I'm going off topic here. I'm not going to cut this out because I think that rant right there, when you truly understand the meaning behind it, and when you truly have experienced stuff like that, you will see the value in that. And if you're completely new, you might think, why is he going off topic? Well, I just explained to you why. And the people that have been in the markets for a few years, they've at least have at least experienced it once or a similar experience, and therefore they can relate and they can appreciate me sharing that wisdom with you. So let us take a look at the following: how to detect if the session is likely to expand. First of all, we must know point A to point B, meaning we must have established a draw on liquidity on the highest possible time frame, relative, of course, to the time frame that we're going to trade. There must be low resistance between A to B, meaning that there's a likelihood for the market to immediately just expand towards a price level that we're interested in. Intermarket relationship is important to confirm whether or not a session is likely to expand. If you want to listen or find more information about intermarket relationship, I would highly advise you to watch the previous lecture in which I shared a lot of insights on intermarket relationship. Because intermarket relationship by itself is a very important topic to discuss and to share insights on and research. And finally, is the lower time frame institutional order flow supporting the thesis from point A to point B taking place? Meaning, is the lower time frame institutional order flow supporting the idea of the market expanding? Session profile conclusion. You must refer to the economic calendar, the higher time frame or institutional order flow, the lower time frame institutional order flow, and intermarket relationship to determine how the current session is likely to deliver, or what the current session's delivery profile is likely to be. Intermarket relationship. First of all, you need to look at correlated markets or inversely correlated markets to determine whether or not these markets are moving in sync. If they are moving in sync, we can anticipate nice delivery. If they are not in sync, we can anticipate choppy delivery. Nice delivery meaning very clean runs with a lot of PD arrays acting as resistance or support on price. And not in sync being choppy delivery, meaning that the market goes sideways for long periods of time, expands, maybe retraces deep, maybe not forming any PD arrays at all, just very messy delivery with a lot of time distortion, consolidation inside of it. In sync being that the markets are behaving in the correct manner relative to each other. Refer to the previous lecture if you want to learn more about this, but simply said, in sync being is that the markets that are highly correlated either inversely or exactly in the same manner should be delivering in a certain way in relationship to one another in order to confirm one-sided institutional order flow. For inversely correlated markets, this would mean that one should, for example, go higher whilst the other should go lower. For correlated markets, this would mean that one market should make, for example, a higher low, and it should mean that the other market is making a higher low as well. If it does not, and that market trades a lower low, that could be a sign of SMT. However, when one of those markets creates a higher high and the other one creates a lower high at the same time, there's SMT on both sides of the marketplace. And whenever there's SMT on both sides of the marketplace, we can anticipate very choppy delivery because the intermarket relationship is not confirming one-sided order flow and therefore expansion. The only thing that it is confirming is that it is confirming very choppy delivery being the case. We're now going to take a look at macros and price delivery. During our time windows, the market should behave in a certain manner once it reaches our point of interest. These time windows are our times of interest or our macros, whatever you want to call them. These times are familiar to you now if you've been paying attention to the model series thus far. If you have made it to the 6th lecture, I'm sure you're aware of what I'm referring to. The reason why time is crucial is because if we understand that these markets are driven by algorithms, that means that these algorithms should behave in a certain manner during a specific time window. And if they do not, if those signs are not present, it's the sign to us that, okay, maybe this session or this whole day is not going to be it. If the market does not deliver in a specific manner during our time windows, we disengage because IPDA is showing to us that it's not going to deliver the way we want it to deliver today. If the market does begin to behave in a certain manner during our time windows, we need to remain patient until the prey walks by. And when the prey walks by, we shoot. We shoot the prey because it's time to eat. Notice that everything that I'm outlining to you can be automated. And when it can be automated, it means that it's algorithmic and it means that it's objective. That's the whole goal of this model series. And it's exactly what the majority of people that even go through this series will not understand. They think it's just a pattern. They think it's just, oh, this is something. No, we're writing code together. We're creating an algorithm together. We're thinking like an algorithm. And by doing so, our trading becomes very mechanical. Do this, don't do that. So here we can see a random day of the Nasdaq's delivery. And what you can see is that I've annotated the macros / times of interest for us. First of all, the 9:45 to 10:15 window is a time of interest for the AM session. What we can see is that from the 9:30 opening, the market repriced higher and it then turned around to offer sell side lower. At 10:07, the market formed a low during our time of interest, 9:45 to 10:15, and it began to show signs of reversing. And from there on, we saw bullish order flow all the way towards the 9:30 buy side liquidity. Notice that every single time of interest is being utilized to expand price, meaning we see it begin to expand here, sideways. Very slow delivery. 10:45 comes along, boom, there it goes, higher, sideways. Wait. 11:45, boom, expand. And that's what I mean when saying to you that during our times of interest, during our macro windows, the market should behave in a certain manner to confirm one-sided institutional order flow. If it does not, it's our warning sign to maybe throw our stops aggressively or get out at all. Let me now annotate some imbalances for you. What you can see is that I've annotated 3 imbalances, or 4 if you count these imbalances as 2. What you can see is that this imbalance right here formed during our time of interest. Market reprices into it, and notice where the low forms, inside of that price range that formed during our time of interest. Market begins to expand higher, keeps on reverting to those two imbalances. Then trend 45 comes along. Market begins a buy program, BC forms, it retraces, there it goes, expand. New BC forms right here, market retraces, begins to expand slowly. 11:45 comes along. Market retraces into this BC that it already traded into prior. Purchase relative weak lows. Boom, there it goes. Begins to expand. What I'm showcasing to you is how time moves price. How the market begins to move during specific times. And this does not occur every single day on the session or on the market and during the session that you're looking at. And therefore, you need to understand that it might occur on another market. And that's okay, because once a week, at least, you will see the precision be present. Here we are on another chart, and what we can see is that from 9:45 the market retraced into a CB that formed after the market formed a high after the 9:30 opening. Market respects that CB, notice that the wicks are tapping into it, and the market begins to expand lower. New CB forms here after displacing below this low, important low. During our macro, during our time of interest, market retraces and it continues to lower. Notice that this delivery right here is beautiful algorithmic price delivery where you see every single premium ray get utilized as resistance on price to continue lower. Market consolidates right here, eventually goes even lower. And here we can see the final example for this lecture, and it's the following. What we can see is that during 9:45 to 10:15, the market begins to expand to the downside. Multiple CBs form, and multiple times the market retraces into those CBs and forms highs in them before expanding lower. Notice that the market is predetermined to go lower during this time window and a sell program originates. But until when can the market go lower, you might be wondering? Until what time is it allowed to go lower? Until the next time of interest. So from here, a high forms around this time window, and then the low comes in around the next time of interest. So what we see is that the market moves from time of interest to time of interest. High during this time of interest, low during this time of interest. Now imagine if you were short above here, anywhere in this area, and you were trying to take a time-based partial. What could you utilize to take that time-based partial? Or what could you utilize to determine when you should take a partial? Besides, of course, price levels. Time. Because if you know that 10:45 to 11:15 is a crucial time window, when it arrives and you see signs of reversal occurring, you know, okay, now I should probably get out because it's likely to retrace deep. And that is what you see. You see beautiful bullish order flow where every single discount array is acting as support on price, and price has one objective, repricing higher, all the way back to the entry here if you went short up here. To conclude, you might feel like I have given you two specific rules, but it is exactly through these rules that the feeling of randomness about the markets gets removed. Because by giving yourself first of all a structure through which you internalize price action, a lens through which you view the markets that is based along the first of all economic calendar, the environment, and then going down into the lower time frames to look for very specific characteristics of algorithmic order flow, you begin to see signs that repeat. And if you see those signs repeat, if you see those signatures be present, then the feeling of randomness will automatically disappear. But that feeling of randomness will always be there unless you start submitting to accepting that Environment selection is key, knowing when these things are likely to work and when they are likely not to work. These concepts, they work during very specific weeks, days, and sessions. If you know this, if you can establish this, why would you worry about the periods that are deemed low probability? Why would you even consider looking at those low probability environments? During this lecture, I've given you a few reasons why you're probably trying to do so. And I truly hope that after you are done finishing this lecture, after you are done viewing this lecture, I must say, that you begin really controlling yourself more and only paying attention to the highest probability environments. So here's a homework assignment that I've made up for you. I want you to go into your own charts and try to really digest what a high probability environment looks like. I want you to pay attention to all the details, meaning I want you to do top-down analysis, starting with the high time frame institutional order flow. Is it clear where the market is drawn towards? Yes or no? Is the economic calendar supporting that the market should draw towards a specific price level? And then go into the lower time frames to see if intermarket relationship is confirming that a specific session can be deemed as high probability. I want you to try and find 15 high probability environments and look for the model so far presenting itself. You will probably be surprised about how many times it occurs. And the reason why this is a very important homework assignment is because the FOMO, the fear of missing out that you are right now experiencing probably, you want to be in every move because you explain why every single move occurs. The FOMO will be tackled by digesting and understanding how many times these things really occur. And when you truly see how many times these setups present themselves that are high probable, that FOMO will disappear because you will come to realize that you only need 1 a week or 2 a week and you're done. You're literally done and you're outperforming everyone. I want to thank you for watching this lecture. Next week's lecture is going to be about psychology, and I want to include risk management as well, because I believe that those two topics are topics that will be very important for you now that you have an understanding of what you're looking for and when you're looking for it, and when you're especially not looking for it. Please try and complete the homework before the next week's lecture, and that way you will be able to be guided as best as possible. I want to thank you for watching this lecture and I wish you all the best. Be safe.